back on a 9 to 5 podcast. It is the Dividend Dog. On tonight's video, I'll be doing a solo video on ETFs. We'll be going over what they are, why they should be on your watch list, and then we'll go over some top ETFs that you guys could build your portfolio around. But before we get into it, just wanted to give a shout out to all of our new subscribers out there. Thank you guys for hitting that like and subscribe button, just so you guys don't miss out on any future updated content. So I'll jump over here to my screen and we will go and look at the first ETF, VTI. So, but before we look into what VTI is, what is an ETF? An ETF is exchange traded fund. So what that means is that when you purchase an ETF, you are not just purchasing one stock, you're purchasing a bundle of stocks that tracks either a sector in the market. And what it does, it helps diversify you, it lowers your risk, and it also passively, gives you income as well with dividends and through capital gains. So jumping back over to VTI. So VTI is the Vanguard Total Stock Market Index. So what this entails means that when you purchase the Vanguard VTI at today, it closed at 192.42. You are purchasing not only just like I said, one stock, you're purchasing Apple, Microsoft, Amazon. These are just some of the top, about 15, 20 in the 15, 20 companies in the ETF, but there's also a whole bunch, 1,000 more that are covered within this ETF. So as you can see, within the 5-year range, it has gone, it's all the way has reached the peak of around 245. Right now it sits at 198.42. So as you can see, long term, 5-year period, if you would have purchased it November 17th, 2017, you would be sitting, pretty high with some gains here, along with, some of the dividend income this ETF produces. So dividends, you may ask. So as dividend growth investors, we do have to look at the dividends and see if it does pay us. So as you can see, we have a 1.6 dividend yield. So dividend per share. So we will take the 318 annually, meaning that per year, it will pay you $3.18. So you're probably wondering like, well, dude, that's kind of lame, right? Well, looking down the line, it grows its dividend over time. Obviously, we've taken a dip here, and we had to take a dip in 2020, obviously, because of the pandemic and what else was going on. But as you can see, it picked right back up to regain the strength it had in 2019, and it's continually going to do that to finish the year. So for a price return and with dividend reinvesting, meaning that every time it pays you, so this ETF pays you every 4 months or every quarter. Once it pays you the amount, let's see here, for 2020, we have it paying us right now 80 cents a share. So as you guys could see from the start of 2022, for 2022, it's right now it's paying us 80 cents a share. So from the start of 2022, it has increased all the way to 80 cents. So as you guys can see, it is just growing the dividend every single quarter, meaning that the companies that are within this ETF are performing as well. Even though the market may not be performing, but we still are able to capitalize on getting the dividend amounts and reinvesting it and purchasing those partial shares. So therefore, down the line, it continued to compound for us. So since 2007, VTI has returned with dividends reinvested. You've gone a return from 184% to 228%. So that just shows you over time this ETF performs with the stock market, and it also produces some income for you. And that is VTI. This is a great one to diversify your portfolio completely. So like I said, when you purchase one share of VTI, you're purchasing literally the entire stock market. Next, we will be looking at VOO, VOO. This ETF tracks the S&P 500. As you can see, over the 5-year period, it has gone from a $200, it looks like, almost up to 363 traded today. But as you can see, at the start of this year, before the market decided wants to, trend downward here, we were almost we peaked over $400 here per share. So as you can see on a 5-year return, this ETF has done 67%, and so has the S&P 500, because obviously it tracks the S&P 500. So once you purchase a share of VU, you are getting access to all of these companies. Basically, as you can see, some of these overlap, but you do purchase some companies that may not be in VTI as well. Now, one thing that you can look at too is how heavy it is weighted. The QQQ is very tech weighted. It has a lot of tech companies in it. 23% of it obviously is tracking the S&P 500. So this one is obviously, it will give you more companies that are in the tech field. Back to dividends, 1.6%. It's giving us $5.88 a share. So that means that annually, every time you purchase one share of this at 363, give you 588. So if you purchase half of this, you would get half of the dividend. So that's how it works. So if you purchase a quarter, you would get a quarter of the dividend. So that's why it's always good to put $10, $20, $50, whatever you have, putting it in, because you're always going to take that money and to produce some type of income with it. As you guys can see here, the dividend has been increasing as well. So within the past years, they've increased the dividend within this ETF 12%. The last 5 years, 4.6%. So this dividend is also, one thing is keeping up with inflation as well, while your money's working for you, and you're not maintaining or doing any of the research to make sure these companies are performing. The ETFs basically wait that stuff out for you guys. So this is VU here, and over time, once again, dividend is a strong increase, obviously up till 2020. We're slowly increasing it back. Companies are starting to rebound back from the pandemic, which is a good sign to see in the market, and companies that you are looking at, seeing how they bounce back from COVID or during the pandemic. And obviously they are also looking, the year's not over yet, so we're going to continue to they're going to obviously increase the dividend one more time here, because they got one more payment for the end of the year. Since 2010, VU's return from with dividends investment has gone from 249% to 309%. So that is just showing, with the dividend, again, guys, with the dividend being reinvested, with the returns, letting the money work for itself, it will produce the income long term, because that's what we are looking to be long term, 10 years, 20 years down the line with these ETFs here. And that is VU. Next, we have SCHD. This index fund, or not index fund, but call it an ETF. It tracks the Dow Jones 100 index. So what this ETF puts all together, the companies within this ETF, they have had to have a dividend increase of at least 10 years. So that means that they've had to show the stock market, show investors that they have a great balance sheet, they can increase profits, along with increasing the dividends, along with having a great product with a great name, and in the market, and continue to produce capital for the investors. So being in this is giving these companies bragging rights, because it takes a lot of companies they can't do 10 years, 20 years to have this type of bragging rights. So I look at these type of companies when I'm looking at my ETFs, is the world were to go out, the world would have shut down right now, we were to stop. Will any of these companies have to go out of business, or these are things that will be in need. Look back at COVID, if we, were to shut down and go back to the way we were, any type of way, these companies will still have to be going. So that's a good sign there, just easily looking when checking out ETFs. I just ask myself, those type of questions there. And it kind of helps you make an educated guess if this should, be added to your portfolio or not. Once again, not financial advice. So the ETF, once again, the dividends produces a 3.2 dividend yield. So meaning that every time it closes out at 76.94, it gives you $2.48 per share. So this dividend yield is for 5 years, it's been growing at 13.1%, and so on down to the 1 year at 8.5, 3 year at 9.5. So those are all great signs with it. Next, we look at the returns. 5-year returns, 84%, great. Beating the S&P 500. 3-year beating the S&P 500, beating the S&P. 1 month, it's crushing the S&P this month. Year to date, we're still above, even though we are negative with the S&P. That is still, there's some good things to see. So we're going to scroll down to the sector weightings. So as you can see, this here is more financial services, industrials, not so heavy tech like QQQ. So this gives you more exposure to these industries here than some of the other ETFs. So it's always good to look at how they are weighting out the sectors in the ETFs, just so you're not overexposing yourself into the same sector, because we want to make sure we have be diverse as much as possible. SCHD, the visuals. Strong dividend growth here, as you guys could see. Full disclosure, I do have over 30 shares in this, and it's annually pays me like $83. So just continuing to get into the dividend, reinvesting it back to the company, and letting the dividends increase, and the payments, you get more value in the company as time goes on. Your value rises along with the dividend growth here. So since 2011, SCHD's returned from 208%. It's gone to 272% of returns. So once again, another strong return with reinvesting the dividends. And that is SCHD. Last but not least, we're going to talk about JEPI. JEPI. So JEPI is a income-based through JP Morgan Chase, and it pays a solid 13.1% dividend monthly. The last 4 ETFs we talk about all pay quarterly, so once every 4 months. This one here pays you monthly. So every time you purchase $55 or whatever the price may be for this, you will get the $7.28 yearly on the dividend. So let's go quickly and take a look at what they are paying monthly. So right now, you can get JEPI at 61 cents per share every time you purchase it at $55.59 right now. So it'll be at 61 cents per share. One cool thing about dividend investing is we like it when the market is red. I like it when the market is red because when the prices go down, the yields, they go high. The yields go higher. So that means when this price here were to drop to about 50, this yield will go up probably to about 14, maybe 13.5%. So it works. It works as a inverse lever, and with dividends. So I like the red days when I'm buying, because I'm getting more value out of my money purchasing. Not saying not to buy on the green days, but the red days are the best days. So we're going to break down JEPI. Let's see. United Holding or United Healthcare is the top one. Hershey's, Progressive, ExxonMobil. So as you guys can see, scrolling down here, these are all companies that would be in need if we were to go down on shutdown again. So that's, once again, that's another way I easily can tell if something is a buy or if I should add it to my watch list or not, is by just, once again, asking myself that question there. JEPI hasn't been around for a long time, guys, but it is growing in the dividend community on Twitter. I see a lot of my followers and a lot of followers that I see buying this on the weekly basis, on the daily basis. They're getting the dividend monthly, repurchasing it back into the company or back into the ETF, and so on. And we're going to skip over and move down to the visuals here. As you can see, this fund really just started up in 2020, but the dividend growth is phenomenal. Now, Of course, we do have that's obviously a red flag. It's like, hey, this ETF doesn't have much history on it. But the companies that are within the ETF have a deep history, and this is also paying you a monthly dividend as well with solid dividend growth. I think, not financial advice, by getting into something early before it takes off is always good, right? So, as you see from since 2020, JEPI's return has already gone from 11% to 36% by having the dividends reinvested. So if we would have gotten into this at $5, guys, I mean, look at this. That's just a layup there. For capitalizing gains and also with dividend growth as well. So those are my top 5 ETFs that I think you guys should put around on your watch list to help build a solid portfolio that's diverse. It'll give you exposure to the entire stock market and even more. Once again, I'm the Dividend Dog, and I thank you guys again for checking out the video. Hit that like and subscribe button, and we will see you guys on the next video.